Good evening and welcome to our Barebone Basics training for this week. I am so excited about the topic that we're covering this week. It's one of my favorites. We're going to talk about dividends. I love dividends. That's free money. Free money that's really easy to maintain and to kind of gauge. You can really manage it. There isn't a lot of guessing games to it, so you don't have to try to predict where a stock is going to go. So that's why this is one of my favorites. And we're also going to have a special session, live session Friday night. And I'm excited about that, where I'm going to kind of give you guys a little bit more insight into my own portfolio and how I manage it. And we're going to have a Q&A session so that we can really get you guys started and make sure that you have everything that you need to be successful. So before we get going, you guys might have noticed the 8 streams or 8 income stream posts that we're seeing a lot on social media. These are the 8 streams of income that are recommended that every individual has. And this really represents what Streamline IG is about. It's about having multiple streams of income, but having it in a simplified way. A lot of times when you think of someone that has multiple streams of income, they have multiple jobs, which all fall under one category, which is earned income. I am one of those that used to do that. At one point, I had 9 W-2s, and that's ridiculous because I was trying to generate more, but I was using up so much of my 24 hours in a day trying to do so that it was too much wear and tear on my mind and my body. So once the realization came that, okay, this isn't going to work, I already had the dividend income going. I had some of the 8 happening, but it was a really challenging scenario to try to get all 8. And I'm happy to say that I have 7 of the 8 from this list. And some of those are in testing phase. My goal is to share those with you after I finish the testing, because I'll never tell you about something that I haven't tried myself. And I'll always show you what the outcome is. And then from there, you can make your own decision as to what you want to do or not do. Also, I'd like to put out there, if you find something that you want us to test, throw it at us. There are 3 of us, myself, and then there are 2 others with me who are actually doing the same thing. And we put our heads together and compare notes off of what we've tried to accomplish with different platforms and vehicles out there, such as Fundrise that we introduced earlier this week. So if you'll notice, dividend income is number 5 on this list. If I had to put a order as to importance of each of the 8, of course, earned income, definitely number 1. You have to have a working job. You have to have money or some type of income in order to invest with. Profit income could kind of fall in that same category if your number 1 method of income is from profit income. After that, dividend income. Why? Because it produces more money. It produces income so that you can do other things with it. So that is what we're going to cover today. In our agenda, we're going to talk about what a dividend is, how dividend stocks work. We're going to talk about the dates that you really need to know when it comes to a stock, which is very important because I'm going to share with you some of my mistakes that I've made. I promised myself that I would be very transparent and that I would give you the good, bad, and the ugly of the pitfalls that I fell into, or the good that I found in certain things. So we're going to talk about different strategies as far as your dividends are concerned, which is very important because in talking with others, if we have a different vision and we're communicating about different companies or stocks, the way we view them are going to be different. And if you don't know what your strategy is, it can become very confusing and it could cause you to make changes that aren't necessary. So we're going to define our strategies tonight. I'm going to review some of the stocks that make up the foundation of my own stock portfolio that offer dividends and give you the reasons why I chose these particular stocks. These are probably going to be companies that you've never heard of before. And I will explain why I chose them, and we'll go from there. And then finally, we'll talk about the dividend mindset. We'll get into understanding how a person needs to think, to process, so that you don't make mistakes in selling too soon or buying something that really isn't good. So we'll talk about the mindset and how we have to change our mindset when it comes to purchasing stocks for the purpose of dividends. So let's go ahead and get started. Okay, what is a dividend? So a dividend is simply a payment made from a company to owners of shares of stocks. So if you own shares of a particular company, they may provide a certain percentage of the money they've earned. They will give it back to their shareholders, kind of as a thank you, and here's some earned income. We earn money. We want you to earn money too while you own us. It's a method to distribute revenue back to its investors. So let's say a company will take a small number, $20,000. Let's say they make a total of $20,000 this month, and they want to give 25% of what they earned to their shareholders, and then they'll retain the other 75% for operational use, or it could be for research and development, or whatever that may be. In that case of $20,000, $15,000 will be retained, $5,000 would be divided among all of its shareholders. Now, of course, the numbers would be much higher than this. Usually they're multi-millions of dollars. And usually, depending on the type of company, the amount that they pay out will vary as far as the dividend payout ratio. There are two types of companies, and we're going to talk about this a little bit later as well, that based off of their structure, it is a requirement that they pay out in dividends most of the income earned back out to its shareholders. And those are what we call REITs, REIT, which are real estate investment trust, and MLPSs. And we'll talk about those a little bit more. Others will vary as far as how much they give out. Typically, it's going to be between 3 to 10% range, because they have to have money for a rainy day. They have to have money to continue to grow. They have to have money to do research and development so that they can continue to produce positive net income so that you can have a dividend. So that's what a dividend is. But how do you get paid? So based off of the board of the company, they decide, the company itself decides how much the dividend payout ratio is going to be. They also decide whether they're going to pay out monthly or quarterly. There are some that pay out yearly. There are also some that may have what they call special dividends. So it may be a one-time payment. For the most part, they're paid out quarterly. So every 3 months, there's a dividend check, or you get cash for however many number of shares that you may own. So for example, let's say we have the company I used this week was Ford Motors. They pay out quarterly, and the share is roughly about $9.30, and they may pay 15 cents per share. If you own 100 shares, then you'll multiply the number of shares that you have by 15 cents, and that's how much you would get back in cash. Now, is that a whole lot? No, it's not. But it's cash that you didn't have to work for. You didn't have to spend 1 minute of your 24 to produce that income. You didn't have to clock into anybody's job to get it. So it's free money. And if you're reinvesting it, it can go back into that same company and buy more shares of stock, or you can choose to have it go to your bank account. That's your choice. Now, there are other companies that pay much higher. There are companies that pay upwards of $1 per share. There's some, generally you're going to find them in the maybe about 25 to 55 cents per share. The key is finding the best bang for your dollar. I would much rather buy 5 shares of a $20 stock than to buy 1 share of a $100 stock. Think about these numbers. Let's say a company costs $100 per share of stock and they're giving 50 cents. If I can find 5 shares of stock for $20 per share and still spend the same $100, and let's say they're giving 15 cents per stock, I'm getting more back from buying 5 shares of the $20 stock than I am the 100. So that's the kind of way I kind of think about my dividend stocks and what I look for. So 3 dates you need to be aware of, and we're going to go a little bit deeper on the next slide, is the ex-dividend date. The ex-dividend date defines the day that you must have the number of shares in order to get a number of shares in order to get a dividend. It's not the day of, it's the day before. So if the ex-dividend date is January 18th, then you must buy your shares of stock by January 17th. That's the deadline, the day before. I had to learn that the hard way. I had purchased a few stocks on the ex-dividend date, trying to be smart and jump in and jump out on something that I saw, and I didn't get anything, and I was wondering why. And I found out the hard way that the ex-dividend date, you have to purchase the shares the day before. Payout date is the date that you will get the actual cash back into your account, or you have it reinvested back into that same company. Dividend yield, which is important. Dividend yield is based off of the amount that you paid for the share and the annual return. And specific here is annual. If they pay out quarterly, then you're going to total all 4 quarters, what you received per share, and you're going to divide that by how much you paid for that share, and that will give you the dividend yield. Typically, I'm looking for around 7% or higher as far as dividend yield, but dividend yield is not everything. And the reason why I say that is that there's some trickery that companies will play, in that they will give out higher dividends to get people to hold on to their stock because they don't want the price of the stock to drop. That's one way that they could play around with their numbers. But there's a way that you can kind of watch out for that very easily. Go and take a look at the history. You can Google a company. Let's say, once again, Ford. If you Google Ford dividend history, one of the first links that you'll have is NASDAQ. And NASDAQ will show you every payout that Ford has made, or any company that you put has made, for as long as they've been given dividends. And if you see in the history that, okay, they normally pay out 25 cents a share, why did they all of a sudden jump up to 75? That's a red flag to me, and I'm going to want to know why. And here is a hint for those just getting started, and for those who don't have a lot of time to do a bunch of research like me. That is the number one thing I do, is I look at the dividend history. How long have you been paying out? If you've just started, I'm not going to trust you. Are you consistent? If you've been paying dividends for 20 years, that covers the last 2 stock market crashes that we've had, and you still paid dividends, there's something good about this company that I can trust, that I'm safe. That's how I look at dividends, in a simplistic method. And I don't have to watch charts. I don't have to watch every show on TV to see what the financial advisors are saying. As a matter of fact, I don't like listening to them when it comes to dividends, and I'll explain that in our upcoming slides. But it's a simple process. Find the company you like. Look at the dividend history. If it's consistent in paying out their dividends, if they're pretty consistent in what the amount they're given, you're pretty safe there, because a company can't pay dividends to a shareholder if they're not making any money. So that's a telltale sign right there. All right. So that's what a dividend is. Let's take a look at how this dividend works. We have what's called the announcement date. This is the date that a company will announce how much dividends they're going to give. And they're going to tell the date, that ex-dividend date, the record date, and the payment date at that time. On this specific date, the actual price of a stock will tend to rise. And the reason why is because a lot of people will start buying them all of a sudden. This is supply and demand. The more people buy a stock, the higher the stock will go. That's expected. How can I use that to my advantage? There are certain stocks that I buy every month so that I can build my portfolio. I do not buy them anywhere around the announcement date. Why? Because it's going to be a little higher and I want to buy it at a lower price. That's it. Very simple. On announcement date, I don't buy. Why? Because that's the date that a lot of people will start buying a bunch of shares of certain stocks, not all, but if it's a good stock that's going to pay a good dividend, you'll see the price start to slightly rise. Nothing major. It's not going to rise by $10, $15 or anything like that. But you may see the stock, as far as the price of a stock, rise on announcement date. Announcement date is the date that a company announces what its dividend will be. And this is a requirement even if the dividend is the same every quarter, if they're doing it quarterly. If they're a company that provides dividends monthly, which I do like those, then every month they'll have this happening. The next date, as I mentioned, the ex-dividend date. This is the date that you have to have your stocks in, but it has to be in by the day before the ex-dividend date. On this date, typically the price of a stock will drop by the amount of the dividend. Key here, if the stock is if they're given 50 cents per share as a dividend, and let's say the stock costs $20, then my expectation is the cost of that stock, the price of that stock, is going to drop down to $19.50. This sounds like a better deal to me than buying several shares at $20 a share. That's a little discount, a little trickery that we can use on our end to know when to buy. Now, will I get stocks on that date that I can get dividends from? No, but I can catch them on the next next round of dividend payouts. Now, how often do I do this? It all depends. If it's a stock I really, really, really like and I want a lot of them and I know I'm buying in a high quantity, then I take this into consideration because it saves me money. If I'm only buying small amounts, then it really doesn't even matter what day I'm buying on. This is more important if you're buying a large quantity of shares. So, what date do you have to have your stocks purchased by in order to get the dividend? By the day before the ex-dividend date. If you buy on or after the ex-dividend date, you will not receive dividends for that particular term. You'll receive it on the next. So if they pay out quarterly, you won't get it this quarter. You will have to wait till the next quarter. That's almost 6 months. Plan out your quarterly dividends so that you can get them in there before the ex-dividend date. If it's monthly stocks, that's not too bad. I'll buy them at any given time because they pay out every month. And typically those are a lot cheaper too. So the record date, if you sell your stock, and here's the gotcha, here's my blooper where I messed up once, never happened again. I sold some stocks. There's a company called SRLP is its ticker symbol. I wanted to get rid of it. They weren't horrible, but they were inconsistent. And there were some things about the company that I didn't like. And I sold them before the record date. So I missed out on hundreds of dollars of dividends that I would have received for this company because I had quite a few shares of them. And I missed out because I sold them before the record date. So you must keep and hold the stocks between the dates of the ex-dividend date and the record date. Otherwise, you will not receive the dividends. For me, after that lesson, I just hold on to it till I see my money as far as my dividends. That just works better for me at this time. So payment date, that's the date that you'll actually either get the cash. As far as dividends are concerned, they'll go back into your brokerage account and then you can transfer it to your bank account if you choose. Or you can have it do what we call a dividend reinvestment. We'll talk about those as well today. So those are the 4 important dates. Know the announcement date, because that day the price is going to rise. And if you're buying in quantity, that's not a good day to buy unless you absolutely just want the dividends for that. Know the ex-dividend date, because you need to buy your stocks before that date in order to receive the dividends that were announced. Hold them until at least the record date. Me personally, my motto is hold them until you get your cash, payment date. And typically, I don't know why, but payment date, you don't see it in your account until like the wee morning of the next day for some reason. Not sure what that's about, but they are good about that. Now, here's why I love dividend stocks. Once the announcement date has been made, that's guaranteed money. I don't have to guess about it. I don't have to pull out a chart and try to figure out where the stock price is going to go. I don't have to listen to CNBC. I don't have to do anything but know when the dates are, have the number of shares I want, and wait for my check. That's why dividends are considered income stocks, and they're considered a safer method. One, because you cannot issue dividends as a company if you're not making money. There are some companies out there that are a little shady, but they're easy to spot. You'll see when you pull the dividend history, a light bulb will go off and say something's not right. You'll see the inconsistency. 1 month they paid stocks, or 1 quarter they paid stocks, and they didn't pay stocks again to 3 years later. And then they paid stocks 1 year, and then they didn't do anything else till another 5 years. That's a red light. That's a keep going sign. Don't buy sign. If you see where the number that they're paying out as far as dividends is not consistent, where one term or 1 quarter they paid out 20 cents, the next quarter they paid out 5 cents, the next quarter they paid out 30 cents and back down to 15, inconsistent. Keep going. That's a company that's not consistent. Companies that you see gradually increasing the amount of the dividend, those are good. Companies now, if it drops a little bit and there's a reason, okay, cool, that's fine. Drop by 1 cent. That's not a big deal. But inconsistency all over the place, that's a red sign, red alert, do not buy, keep going for me. And that's only looking at one thing, and you can Google that. Dividend history, the name of the company, dividend history. As a matter of fact, on Friday night at our Friday night insight, we're actually going to do some examples of that. I'm going to show you some. I'm going to show you the history of some of the stocks that I have in my portfolio. That way you can kind of get a feel for it and actually get some examples. So this is how the dividend stock works. So now, we talked about a dividend yield. Key factors. Dividend payout history is my number 1 factor for my dividend stocks. It's not what anyone else says on any financial show. It's all about the dividend. Perfect example. We're going to use Ford. That's our company for this session. Ford has been around $9.30. It's been pretty consistent there. Almost 10 years ago, Ford was about $4 a share when I first started buying them. Consistently, they have paid the same amount in dividends since 2003, I want to say. That's a very long time to be paying dividends for people to say that Ford is a don't buy stock. How is it they're paying dividends consistently every quarter the same amount, but you have some analysts that say don't buy it, you have some analysts that say buy, you have some that say strong buy right now? That will drive a person crazy because that's a lot of opinions to keep up with. With dividends, it's not about opinions. It's about consistent dividend history. And the reason why I keep going to dividend history is because any stock you buy is going to go down and up, down and up. It's going to go like a roller coaster ride. And if you're watching that only, it will drive you insane. Or it will cause you to sell things that you shouldn't be selling. Ford is a perfect example. It's going to have its highs and its lows, but it's always going to pay its dividends. I buy on its lows so that it can continue to have, I can continue to get higher amounts of dividends later. So if I can buy it for a lower cost, perfect. Good for me. When everyone else is selling, I'm buying because they've consistently paid out dividends over the years. So dividend payout history is my number one key factor to look for. My second factor I look at is dividend yield. Dividend yield is the annual total dividend that they give out per share divided by its current stock price. As I stated earlier, I tend to look for stocks that are around 7% or higher. I do have some that are lower, and that's because they're conservative, consistent. I can buy them and never have to look at them again. One of those for me is Coca-Cola. Coca-Cola has been giving dividends since I was born. I'm joking, but serious at the same time. Coca-Cola isn't going anywhere. They don't give as high of dividend. The average price is about $50, and they may give out 20 cents or something like that. So you don't get a lot for the cost, but it's consistent. Don't have to worry about it going anywhere. Here's a little nugget for you on the Coca-Cola. I'm expecting, and this is getting a little bit outside of dividends, but I'm expecting some growth with Coca-Cola in the coming, I would say, next 3 to 5 years due to some research and development that they're currently doing in the realm of CBD and things that they're going to be offering that they already have ready to put on the market. They're just waiting for approvals. So when I know things like that and I get dividends, yes, put those in my portfolio. But for now, we're focusing on just dividend. So Coca-Cola is one of mine that's, the dividend yield is not high, but it's consistent and it's safe. Payout ratio, lower is better. We talked about payout ratio on the previous slide. And that's how much they are paying out to their shareholders from their net income. For your normal companies, lower is better. Why? Because you want to know that they have a safety net such that if hard times does come, they're not going to go under as a company. If you're giving me all of the money you make and you have nothing if hard times come, then I risk losing everything if you falter. The only companies that does not apply to are our RITs, our real estate investment trusts, and our MLPSs. Last thing is find the best opportunity for your dollars. I can't stress this enough in that starting out, you're going to start looking for companies that you know, which is fine. That's perfectly fine. But most people look for, okay, Facebook. Facebook is wonderful. It's great. I bought them when they were $17 and now they're over $200. As a growth stock, they're good, but they don't pay any dividends. Not a single dime. Amazon is great. Amazon is $1,800 in that range. I would much rather take that $1,800 and buy as much as I can of things that are going to give me instant income than to buy one share of Amazon. And I can't earn anything unless the price of that stock grows. That's what a growth stock is. You wait for the growth, and when it grows and you sell it, that's when you make money. Dividend stocks, I don't have to sell anything. I get the money just by holding it. They're paying me to hold the stock, not sell it. That's the major difference. So you want to find the best opportunity for your dollars. For me, that stock's between $10 to $20 a share. I can buy a lot more of them. When I show you my portfolio, you're going to see that I have stocks that cost $5. I can buy tons of those. There's room at the table for everybody. I can't stress that enough, that $5, a kitty Happy Meal or a Happy Meal or Wendy's, whatever kitty meal they have, $5 can get you one share of stock that can produce income for you. So that's the key factors I look for. Dividend payout history, if nothing else, that's the one thing you can look at, and it will give you a solid understanding of where a company is. Dividend yield is my second thing that I look at, but there's some trickery there. I'm still going to look at the payout history regardless of what that dividend yield is. And then, of course, the payout ratio, and find the best for your dollars. So what kind of strategies are there? So if you're investing long term and you're trying to build up your portfolio, I highly recommend you do what's called a drip. And what a drip is just basically taking the dividends, the cash that they're giving you when they're paying out to you, let it reinvest back into that same stock. So if Coca-Cola just paid out, let's say I get a total return of $5 in dividends, it will automatically buy $5 worth of that stock. So that's where it would go from having 10 shares to 10.5 shares or 10.08 shares. And over time, it will start compounding depending on the number of shares, but it will help you to build. So if you're having compounding going on where the money you're getting is going right back into that stock and you're adding to it, it will grow faster. So those just getting started, I highly recommend you start with a long term where you have your account set up to do a drip. Now, all brokers, which is what you have to use as your platform to purchase stocks with, do not offer drips. Cash App does not offer drip. Robinhood currently does not offer a drip. E-Trade does. Any of your online platforms will. Your apps tend not to do so. There is one that does. I believe Stash does automatically. You don't have a choice with apps, whether you can turn it on or turn it off. I believe in time that will change, but right now it isn't. And that's fine, because what can happen is, let's say you don't have a drip option. Okay, let the cash go to the account, let it build up. When there's enough to go buy something, go buy. That simple. So there's alternatives there. Short term, I don't know many people who have a dividend portfolio for short-term purposes. The only time I've ran into something like that is where someone had hundreds of thousands of dollars that they wanted to sit somewhere for a short term and earn income on it, and then pull it for a specific purpose. If you're not putting in hundreds of thousands at a time, then there's no point in doing short term. Most people that set up a dividend portfolio set it up for the long term. Now, another strategy is the types of stocks that you buy. Blue chip stocks are what we call our safe zone stocks. Those are your well-known companies that you know aren't going anywhere. They tend to pay a lower dividend yield, but they're safe. If you look at the Dow 30, and we talked about the Dow in one of our previous BBB sessions, those are the top 30 companies according to the Dow Jones. And most of them give dividends. Most of them are pretty safe as far as you don't have to worry about the company plummeting. You don't have to worry about the company selling to somebody. They've been around for 30 plus years or 20 plus years. They're solid companies. They're solid, safe companies. Now, when I say solid, safe, that does not mean that the stock price doesn't go down. But as a dividend investor, you're not looking at stock prices. You're looking at how much income I can get, because you already know the stock prices are going to go up and down. That isn't, as I tell myself, the stock price isn't my business. What's my business is the income that I make from dividends. Now, if the stock price goes down, great for me. I can buy more at a lower price and actually make more on it if I were to sell them based off of its growth as well. We'll get a little bit more into that hybrid situation a little later. But chip stocks are your safe zone. So blue chip stocks are your Coca-Cola, your AT&T, your Johnson & Johnson, P. Fitzer, Home Depot, those companies that have been around forever. And all of those give dividends. It's just they're going to be really small based on the cost. Most of those companies are going to be upwards of $50 to $75 or higher per share, and then turn around and only give you 20 cents in dividends. I can do better than that if I can buy a $10 stock. So for me, I do have some blue chip stocks for safety. I like to mix it up. So I have some that are in there that are safe stocks, and then I have some aggressive stocks and some that are there for different purposes. So if you're just getting started out and you're feeling a little uneasy, I would say your strategy should be to buy blue chip stocks first. Buy companies that aren't going anywhere. When I first started out, the company for me was McDonald's, because McDonald's is everywhere. I believe McDonald's is going to be in heaven. It's just everywhere. And no matter how bad the food tastes now, they're still doing extremely well. When I first started buying McDonald's stock, they were about $45, $50 a share. Now they're a little over $100 now, and they pay dividends. The dividend yield is low. I believe their dividend yield is maybe 2.8%. It's safe, and you get dividends. You're going to pay more for the stock, but it's safe. So all of them aren't that way. You can find some blue chip stocks that are a little bit lower. AT&T is about $38. I've been buying lots of them for different reasons. I might share the reason why with y'all on Friday night, because it's an interesting story. Think 5G, and that's why I have building up my AT&T stocks there. Next is a mix of conservative and aggressive stocks. Now, if you want a balanced portfolio, get some safe zone, get some blue chip stocks, some conservative stocks, things that, you're not making 12% in dividend yield, but you're making 4, 5%, 6% consistently with a company that's solid. They're not going anywhere. It would be a miracle if they went anywhere. Like McDonald's. It would be a miracle because they're everywhere, and they're just not a burger company. They own real estate. That is actually how they make their money. They're real estate. So a mixture of conservative and aggressive stocks. What is aggressive stocks? Stocks with companies that aren't as well known. I'm still looking for dividend history. It's just that I might be looking for a higher dividend yield. I pay less, they pay more in dividends. And the mixture of that can kind of offset some of the aggressiveness and put a little bit more of a safety net around your portfolio. Me, personally, I do all of the above, except for that short-term stuff. If I'm going to buy something for the purpose of income, I'm usually going to hold it, and there's a tax benefit to holding. For tax purposes, if you hold a stock for at least a year, you do not have to pay you pay capital gains tax and not an income tax. My tax bracket is a bit high. I don't want to pay any more income tax on anything else. I might get a little heated because taxes are a sore subject for me. I don't have children, so I have to pay much higher taxes. So with this, I only pay 10% in taxes, which is a capital gains tax. It's 10%, which is much lower than 35%. So if you at least hold it for 1 year, you pay lower taxes when you sell your stocks or on the dividends that you get. I highly recommend, once you start getting in high numbers with your dividends as far as what you're getting, talk to your tax accountant. We have a few who are actually members of Streamline IG. So if you speak up, they can always probably give some advice. I think I'm going to ask someone if they will kind of join me in one of these sessions and give you guys some advice. If interested, let me know. All right. So, wanted to give you some sample offerings. I mentioned about REITs and MLPs having a unique financial structure, which requires them to return the vast majority of their earnings to their investors. I like that. So almost everything you see in this sample. Now, mind you, my actual portfolio has about 30 plus stocks that I buy into and I manage for my personal account. Here are my top, I won't say my top 5 because there's actually a few more on there, but the main income stocks that I have. I'll start with the first one, Main Street Capital Corp. The cost, they're around $43.38. I made these slides a couple of days ago, so it may be a little off, but in the general ballpark because numbers change daily. They pay 21 cents per share. That's not a whole lot, but they pay monthly. That means every month, every share of stock that I own, I get 21 cents per share every month. Here's why I like this particular company. They give what's called special dividends twice a year. So instead of getting just every month, which is 12 times I'm getting income, I get 2 additional, which makes it 14 payments that I get in income from dividends. Every 6 months, there's a special dividend they give out. And this company is in position to grow as well. As far as the price of the stock, we're expecting it to grow. Now, is that the only reason to get it if I'm doing dividends? As far as my strategy, no. The strategy for dividend stocks isn't about the price of the stock. It's about how much you're getting in income. So the ex-dividend date for this one is January 21st. So if I want to add more shares of stock and get paid for this month's dividend payout, then I have to buy it by January 20th of this month. For the total number of shares that I own, let's say I own 100 shares of Maine, then 100 times 21 cents is what I'm going to receive from them, which would be $21. And I would get that on the payout date, which is February 14th. That's how that works. The next one now, Main Street Capital Corp, they deal a lot with finances. NRZ, which is New Residential Inventory Corporation. This is a RIT. So they deal with real estate. Cost around $16.22. They pay 50 cents per share, which has a yield of 12.34%. And they pay quarterly. They're about to make a payout on January 31st of this year, but it's too late if you don't already own shares of them because the ex-dividend date was December 30th. Now, does that mean don't buy them? No, it doesn't. If this is something that I were choosing to try to start building up, then I would start buying immediately. I would try to buy as much as I can, except for on that announcement date, because I want to try to get it at the lowest cost I can. And I would jump in on the next quarter, the next payout for this. If they're paying January 31st, then the next payout will be in 3 months. So February, March, April. End of April time frame is when this one will start paying out again. Typically, the dates will fall in line every 3 months. If it's quarterly, every 30 days if it's monthly, like clockwork. Starwood Property Trust, STWD, $24.76 a share. They're paying out 48 cents, 7.75% yield. They pay out quarterly. And what I like about Starwood is they deal with real estate. They are a mortgage company. And they handle all the mortgages themselves. So I'm getting some of the income made by mortgage companies by investing in their company, buying shares. AMZA. Now, here's where we're getting into the special category where they have to pay out their income to their investors. That's why the yield is so high for AMZA. If you'll notice, it's only $4.71 per share. And yes, the dividend is only 8 cents, but you're paying less than $5 for the stock. But the yield is 20%. Almost 20.5%. And they pay monthly. I could load up on this alone. And that 8 cents turn into a lot over time. And it pays monthly. So for every share owned by the 2nd of January, not the 3rd, because you have to have it at least one day before, the payout for that went out on January 9th. And that hit my account as far as cash was concerned. As I mentioned, I added Ford to my list for the month of June that I'm building up. And it's a $9.30 range is what it is now. On the date of this, it was $9.25. They pay out 15 cents. It's around 6.5% yield. Still good. And they pay quarterly. The reason why I added forward is my strategy for myself is to build income to where every month I'm getting up a total amount of dividends to where, let's say I want to be able to pay both my car notes or something. Or I make up stuff as a game for myself to make it kind of fun, where I'll say, okay, I want to build my dividends up to where I am getting enough dividends to where I'm paying my mortgage, or I'm paying off, I want a new car, and I want enough dividends that my dividends is paying the car note and not me. That's how I process and think through it. And that gets into the dividend mindset, which is next slide. So I added forward because I wanted to find more stocks that paid out on certain months. I'm trying to build up my February and March, because my January was kind of heavy loaded, so that I'm getting more income in those specific months. And for me, that was one of the reasons why I added forward. Plus, when I looked at what I was already getting from them, I wanted to add more because it's in the range. It's less than $20 a share. Consistent company. If anything were to happen to Ford, you would hear about it on every news channel, every newspaper, every social media there is. And at that point in time, if the entire auto industry were to plummet, you would have time to sell and get out before you lost everything. So that's why I like dividends. It takes a little bit of time. It's not going to disappear out of thin air. If it disappears, I wasn't paying attention. I had to have been in a coma somewhere, because it will be on the news if something happened to Ford. Now, some of these other companies that are unheard of, that's different. Now, I do monitor those. I might check that. I check my account maybe once a week, and that's only because I'm constantly buying stuff. If it's an aggressive stock, I will check those. The last one on here, PFFA, is considered a stock that is specifically made for the purpose of producing income. We call that an income stock. Everything that is made by this particular trust is given back out to the owners of it. What they do is they buy up all the companies that offer what's called preferred stocks. Preferred stocks are stocks that the owners of them, they get paid before anybody else. Your typical stocks on the stock market are what we call common stocks. Before anyone else get paid, the preferred stockholders get their money first. You don't see that on, it's not common to see these. This is not something you hear about and say, hey, I want to go buy some preferred stocks. That's not how that works. Pretty much you're going to stick to buying common stock shares. So what this trust does is it buys up, it has companies that it invests in, and then you get profit off of it because it's a preferred share. So they get the first of the income produced off of the company's assets. That's why it's called an income stock. And so I like to have at least one of those. I have two. I have PFFA and PFFR. Both of them, this one pays out a little bit higher and it pays monthly. That's why I have that one. I like my monthly paying stocks because I can grow them faster because of the compounding. So a mixture of those. So on Friday, I think I'm going to let you guys see my entire portfolio. One-time deal. I want to be transparent and show you what's going on there and show you the good, bad, and the ugly. Actually, there isn't much ugly going on there. Thankfully, I've done pretty well. The ugly for me, as far as stocks has been concerned, has been more of shifting my mindset earlier when I started and not jumping off and selling stuff just because I hear something on the news. And it took some time to develop that. Now I'm pretty good. I don't follow the herd, as I call it. I stick to my income. All right. So mindset is everything when it comes to dividends. Your focus is to create consistent income, not get rich quick. If getting rich quick is what you're looking for, then dividend income isn't the method to that. Actually, when it comes to stocks, unless you have a lot of money to start with, none of it is. And if you're looking to build very quickly off of a growth stock, then you need to have a lot of information because there's no guarantees when it comes to growth. As I mentioned, and I've stated this repeatedly, look at the dividend history of each company that you buy. You can Google it. It's easy to get the information. We're going to go through some samples Friday night. Watch out for value traps. And what value traps are where a company will dangle in front of you this great dividend yield. Here's all this dividends. We're a great company. But when you go and look at the history, it doesn't show that you've been a great company over a course of time. Value trap. One of the reasons they may do this, like I mentioned earlier, is that in order to control the price of a stock, one of the ways you can do that is by making your stock appealing to others. One of the ways you can make it appealing is by giving high dividends. The more people buy it, the higher your stock price will go. Here's how the game is played when it comes to value traps. If let's say I am an insider, I work for a company. I know what's going on inside this company. I want more people to buy it so I can sell mine and get out of it. A value trap is a great way to do that. If I can throw some dividends out there and people jump on board and enough people buy it, and it's not guaranteed that it will work, but if enough people are buying and the value of the stock starts going up, the more a stock price goes up, the more eyes it's going to catch. They can sell their shares of stock and make money off of their shares of stock by doing value traps. So easiest way to identify those, go look at the dividend history. If this isn't common for them, all of a sudden they normally give out 15 cents a share and all of a sudden they're giving out 75 cents. Something is wrong. Does that mean I absolutely won't do it? It all depends. I would advise doing that when you're more advanced and comfortable with it, because I will jump in on something and jump out. If I'm buying in large quantities to where I can offset if the price of the stock starts going down, I might jump in and jump out, just so I can grab those huge gains and then get back out. So how would that work? Let's say they're giving 75 cents per share and the stock price, I know it's going to start going back down. I might jump in because I have to hold it for a period of time. If I believe that I can jump in and get that 75 cent per share, and I can buy in a large quantity and jump out before it goes down below 75%, a 75% loss in the price of the stock, then I can make a gain there. How often do I do that? Not often at all, because it's too much work. And as I mentioned before, I'm trying to own my 24. Don't have time. That's too much. And my doctor said I need to minimize my stress, and that's kind of stressful. So I don't do that too often. That's more of a gamble and a much higher risk if you're going to do that. But like I said, watch out for value traps. High yield isn't everything. And the reason why I say that is that you can get consistent dividends and do just as well. The higher the yield, the more, how do I want to put it? The more riskier it tends to become. If you have companies with 20% dividend yield, you might want to ask why. Unless it's one of those special circumstances, as I mentioned before, like a RIT or MLPS. Otherwise, dividends that are above 15% is kind of out there. That's a bit high. Stick to your strategy. I cannot state this highly enough. And the reason being is that when you really start digging in and buying your stocks for the purpose of dividends and creating income, You start talking to people, you get excited. And what happens? You have your negative Nancy's. We've all experienced it. That's not good. That's risky. That's this, that's that. And then next thing you know, in your mind, you start thinking, maybe I shouldn't be doing this. Well, maybe not. I can't speak for anyone. But your strategy is your strategy. Perfect example. We're going to use Ford, our sample stock for the evening. If you're buying Ford for the purpose of dividends, you see that Ford has consistently paid out dividends. You see that Ford even paid dividends during the time where the automotive industry was in perils. They were still paying dividends through that time frame. If that is your purpose, then the price of the stock is not your business. That's how I talk to myself. The stock price isn't my business unless I'm going out to buy some more. Because it's going to take its dips and it's going to have its highs. It's going to have its highs and its lows. If you're purchasing for the purpose of growth, that is your strategy, then you are paying attention to the cost. You are paying attention to the price of the stock, which what most analysts are looking at are the stock prices, not the income of the stock. So that person's strategy may be completely different than yours. So their outlook on something is going to be different on your outlook on that same something or same stock. So you're going to have to get it in your mind. What is your vision? What is it you're trying to accomplish, and stick to it? If you stick to your vision, am I saying don't talk to people? Absolutely not. Talk to everybody. That's how you learn. But be strong enough in your strategy of what you're trying to accomplish to where when somebody says, oh, that's not good, this is a risk, that's the risk. I've heard that about everything I've ever tried to do in life, including when I started my path into becoming a computer engineer. I took risk. I've always taken risk my entire life with things that I've done. I've done some little crazy things that I'm almost 45. It's like, wow, that was dumb, but it paid off. So know your strategy and know why you're doing what you're doing and have your own convictions about it. And by doing that and knowing your vision, no matter what's being said on the news, do you want to pay attention? Absolutely. Now, if Ford was selling, hey, sell my stocks right now, immediately. Stock market opens at 9:30, 9:31, sell my stuff. But other than that, they're not going anywhere. McDonald's isn't going anywhere. Now, if you have companies that are more risky, more aggressive, then that's a different story. But even with that, you'll have time to sell your stocks and get out before any major actions happen or anything. So stick to your strategy. As I mentioned, financial analysts have a different strategy. There are shows upon shows upon shows that you can watch about the stock market. I don't like any of them. And that's being comical. I do enjoy watching shows. I watch Susie Orman and you name it, go down the list. But their strategy of what they're accomplishing or looking to do may be different from mine. And I know what has worked for me. And when it comes to dividend investing, I'm not looking for price of a stock. I'm looking for what is going to give me a check every month or every quarter. So you're going to have to set your mind on your dividend stocks that it's not so much about price because it's going to go up and down. Think of it like a roller coaster. What is your purpose of riding a roller coaster? It's for the enjoyment, for the excitement of it. Are you not going to ride the roller coaster because it's going to take dips or it's going to have its highs and its lows? No, because the purpose of riding a roller coaster is for the fun of it. Not whether or not it's how high it's going to go or how low it's going to dip. Now, if this roller coaster is too scary, you're just not going to get on it in the first place. Same thing with stocks. If it's too aggressive, you're not going to buy it in the first place. If your purpose is to make dividend income, then you know it's going to have its highs and its lows, and that's something that you accept. And when you're ready to sell, I'm going to sell when it's high. And when I buy, I'm going to buy when it's low. And that's how I use that. So that's the dividend mindset. So we have our first Friday night insights this Friday at 8 p.m. I'll probably be online a little early. So if you have some specific things that you may want to jump in a little early and ask, I'll probably be online anywhere from 15 to 20 minutes before we start. And like I said, my plan is to open up and show you guys one of my portfolios. I have a couple for different purposes and reasons, and kind of walk you through the process of picking and choosing stocks. Some of the tools that I use to manage my dividends, because one of the things that they don't do a good job of with the brokers is showing you your complete profit. They'll just show you based off the stock price, but they don't include the fact that, okay, you just made $200 in dividends yesterday off of this one stock. So my stock may show that I'm negative $5 today, but I'm really not, because I just made $200 today. That's the part they don't do a good job of showing. So I use a different tool to manage my stocks as far as to seeing the entire portfolio of how well it's doing. So I'm going to show you guys a free one, and I'm going to show you the one that I actually paid for. And I'll probably go ahead and share with you some of the tools that I use now, some of the paid tools that I've paid for to learn and grow, some of the books that I've used to learn and grow. I've been studying this for about 20 years. So off and on, just try to give you everything that I have to make sure that you can make the best informed decision that you can in making your portfolios there. So that is it for tonight's session, and can't wait for Friday. Have a great evening.